Friday, February 6th. First Friday every month. We get the job statistics from the immediately prior month, and today's set of job stats is the biggest surprise in years and years and years. The January number of jobs wasn't so big, but the revisions to November and December were huge, and we're all Pavlovian in the markets, and a strong jobs data report correlates with inflation and theoretically with rising wages, and should be strong enough to take the Fed off of any doubt that it ought to begin to raise interest rates by summertime. And yet there are all sorts of reasons to doubt whether that's the right thing. It's in the copy beside this video, as are a bunch of charts that are important. Most important piece in the charts, as we look back a year, the yield on the 10-year Treasury note, which is what drives mortgage rates, fell from 3% to, as of Monday, 1.65%. It's a huge drop. And all during the year, the thought is, the Fed's going to tighten, the Fed's going to tighten, the Fed's going to come up off zero, the Fed's going to lift off, and long-term rates keep going down. Meanwhile, the 2-year Treasury note, 2-year, you don't have long to make money, and you can lose money quickly if the Fed tightens. So the 2-year is the weather vane for the Fed. And in the last year, the 2-year's been going up and up and up. And that's known as a flattening yield curve. It's one of the all-time signs in the marketplace that the economy is not only about to soften, but it may tip over into recession. Every recession in U.S. history has been preceded by a moment when short-term rates rise above long-term, which ought to warn the Fed, don't you dare, don't you dare, don't you dare. We've got a bunch of new jobs, we don't have any new income, there are other weaknesses in the data coming by. But the conundrum for the Fed is these long-term rates that have been going down for a year, are they going down because there's no inflation risk and the economy is going to soften? Or are they going down because frightened money is pouring into the United States? The 10-year German Treasury note equivalent trades today at 0.34%. It has converged with the Japanese 10-year T-note at 0.34%. So U.S. long-term interest rates, close of business today, are 6 times as high as they are in Germany and Japan. The conundrum, and I don't have an answer for it today, I'm as slack-jawed staring at what happened today as everybody else, but I'm very much in doubt that it means that all rates are going to rise or that the economy is off to the races. The Fed's conundrum is, are these overseas rates down because there is a wave of deflation that is on its way here? Or is the deflation overseas just washing money here, and the drop in long-term rates is an illusion that the Fed should lean against? Do have a good weekend. Thank you.